Hi, welcome. I'm David Holland, and this is PlanStrongerTV. I'm glad you joined us today because we're going to be talking about annuities. Lots of different types, thousands of choices, plenty of confusion. So we're going to dig into this subject and help you understand how they can be part of an overall retirement plan. Let's get started. Welcome back. So annuities, are they appropriate? Do they make sense for you? Is it a good idea, a bad idea? Just go on the internet and you'll find out. There's a million different opinions and ideas about annuities. Let me break it down for you because I want to spend some time on today's program explaining how annuities can make sense and also when they don't make sense and what they're good for and what they're not good for. So we could talk for 3 hours on this subject. We're not going to do that. We're going to talk for a shorter period today about that. So annuities in their most basic form is an exchange of money for a promise to pay income or cash in the future. So you give money to an insurance company and they promise to pay you income the rest of your life. That is the most basic form of an annuity. Annuities have been around for centuries, but in today's world, modern era, you put money into an insurance company, they will pay you income during your lifetime. Now, over the years, annuities have evolved and they have new features. They've got new types of options for you and how to structure the annuity to fit your situation. Over the last 10 years or so, over $2 trillion, trillion with a T, has gone into annuities in the United States. I don't know the worldwide number, it's I'm sure much larger, but the point is it's a fairly popular investment or financial product. However, with the sheer magnitude of annuities that are done and the number of different versions and also the number of offering from insurance companies, there has been an explosion in choice. And that has led to confusion and sometimes the misuse of annuities for individuals in their particular circumstance. So what we're going to do today is dig into these different types of annuities, go over the 4 primary types, and talk about when they make sense and when they don't, and things that you need to know if you're considering an annuity and if you already have one. And what are some things to know about that make sure that, again, you're getting the best you can from your money that you put into an annuity and for your use of an annuity as part of your overall plan. So let's get to it. Welcome back. Annuities, 4 primary types, thousands of choices, and there is confusion. Now, I will tell you a couple of things up front. Number one, I have used annuities as part of a financial plan for many clients, and used properly, I can tell you that I've seen them work very well. I've also seen situations where people have had an annuity and it wasn't really the right choice for them, or it wasn't used correctly, or there was some other element to that annuity or their situation that made it not a good fit. Getting an annuity and making it part of a financial plan, very good. 2 thumbs up on that. Looking at an annuity as a financial plan, no. Getting an annuity does not mean you've got a financial plan. It means you have a financial product. Now, does an annuity fit? Totally depends on your personal situation. Often I've seen an annuity fit, especially for people who are getting closer to retirement or are in retirement. I've seen an annuity be a sensible part of an overall plan. It's kind of like the breakfast cereals you hear them say, and this is a sensible part of an overall balanced breakfast. Well, an annuity can be that sugar cereal. It can be part of an overall plan. But you've got to have balanced. So the thing to know about annuities is that there can be confusion because there's 4 types, there's lots of choices, and this is key, sometimes financial people either don't use them properly or don't recommend them correctly. Either they are ignorant themselves. I didn't say they were dumb. They just are ignorant maybe of how that particular annuity or other annuities might work. You know, getting an insurance license doesn't really make you an expert. It gives you the minimum level of competency and gives you a license with the state that you do business in to be able to transact the annuity for the client. So, getting an annuity from an agent, they're supposed to know how that annuity works. They're supposed to evaluate whether it's appropriate for you for your situation, but sometimes they don't know. And I've seen situations like that where the agent didn't really understand the product themselves. I know that sounds strange, but they really didn't understand it. The other problem is sometimes, there's no way to say it nicely, sometimes the agent is just selling and is just putting people into the annuity to make their commission. I've seen a case recently where I saw an agent, a licensed insurance agent in Florida, recommend two different people. I saw both of them came to me after the fact, unrelated to each other. They just happened to both come in to see me for a second opinion. And in both cases, that agent had pretty much taken every nickel they had that was available money and put it into the annuity. Now, I think that's flawed at the get-go. I don't think you put all your money into an annuity. It can be part of a plan, but it's not a plan. And you have to maintain liquidity for your finances because an annuity, in its very nature, you're making a commitment to putting that money with the company, and it's going to give you a benefit in the future. It's not a place to put money you need for liquidity. So there are a lot of reasons why annuities have created some challenges for people over the years. Used correctly, they're great. Not used correctly, not good result. Now, one of the things that we need to recognize is there's 4 types, and I want to talk about that now with you, that there are different types and how they might make sense. So let's get into that. So 4 annuity types. What are they? Well, let me give you the quick overview. Number 1, immediate annuity. Number 2, fixed annuity. Number 3, variable annuity. And number 4, index annuity. Those are the 4 types of annuities. Now, there are a few that are kind of variations on that, but those are the 4 major types of annuities. Some of the confusion comes from the fact that there are 4 types. So when you consider which annuity may make sense, they might be used in different situations. So let's walk through them, and you'll get a sense for when they might be appropriate and when they might be the right thing to consider. The first one, the immediate annuity. The immediate annuity is actually the first type of annuity. It was the one I was describing earlier where you take a lump sum and you give that to an insurance company. And in exchange for that lump sum, the insurance company is going to accept a risk. They are going to accept the risk that you will live a very long time because they're going to pay you a monthly or annual or whatever is the structure of the contract, but generally it's monthly, a monthly income the rest of your life, and maybe if you're married, for your spouse's life as well. So what are they betting? They're betting that they can invest that money you give them, pay you, and still make a profit. They're also betting that, and they do this with lots and lots of people, they're betting that on average, some people will die later, some people will die sooner, and that on average, they'll make money on the average. So they have priced the product, they have figured out, and they use actuaries. You ever wonder what an actuary does? This is what an actuary does. Actuaries figure out all that stuff, and they know how much they can pay you each month, and on the average, over time, they will make a profit by covering the spread, if you will. They might not like I call it this, but it's a little bit like a bookie, okay? So they're covering all the bets from people that might live too long or people that might live short. Now, that is a basic annuity. Now, there are variations on the immediate annuity. There's different types of annuities within that immediate annuity category. You can start changing and adding features. But the basic concept, lump sum of money, exchange for a stream of income in the future. And that income might start right away, or it might be deferred and 5, 10, 15 years down the road, then it starts. All right, the second type is what's called a fixed annuity. The rest of the annuities I'm going to talk about are all deferred, not immediate. So the words and titles here matter. You have the immediate annuity, and then you have 3 types of deferred annuities. Why are they deferred? Well, we're not going to draw money from them right away. That's what makes them deferred. The first type is the fixed annuity. A fixed annuity, you put your money in, your money is secure, it's guaranteed by the insurance company, and they will pay you interest on your money that you put into the annuity. The money sits there, it can grow, the interest can compound on the principal, and at some future point, a year from now, 10 years from now, whenever it is, you can draw on this fixed annuity. And you can even later turn it into an immediate annuity, have it convert over and then pay you an income the rest of your life. A lot of people never do that. They simply draw what they want from the annuity because while it is deferring, there's a specific tax law or tax rule that allows that to grow without taxes. So it's tax deferred in addition to just be deferred in the payment. Now, the interest, depending on the interest rate environment, may be higher or lower than a similar term CD, certificate of deposit. So fixed annuities often compete with CDs from banks. So the insurance companies and the banks will compete sometimes who's got the best interest rate for the period of time that you're willing to commit your money to an annuity. Most annuities require a commitment period, a surrender period, a period during which if you take all your money out, there is a surrender charge. Now, this is one of the places where people sometimes get tripped up and also, unfortunately, where agents, financial people fall short of helping the client understand how the annuity works. I've had people come into my office and say, well, I know I can get money out of this annuity next year. I'm thinking ahead, what should I do with the money? And I look at the contract and they can't get money out for many more years later than they expected because either there was a communication breakdown between the client and the agent or the agent did a poor job of explaining that. Give everybody the benefit of the doubt, but there was some sort of miscommunication or lack of communication. So you do need to expect to make a commitment with a period of time with the annuity, which is why when I talk about annuities being part of an overall financial plan, they're not the plan because you don't want to tie up all your money in an annuity because you don't have the liquidity. And if you had to pull it out, you might pay a penalty. That's counterproductive. All right, 2 annuities down, 2 more to go. The third type is the variable annuity. Now, I will tell you, variable annuities have been a big part of what's gone into annuities over the last 10 years or so. They've been a big part of that. They are both, variable annuities are an insurance product, but they're also a security product. So that's one additional layer of complexity, and they're typically offered by licensed securities brokers, registered representative, stockbroker. That all means the same thing. So you go to a broker-dealer, a stock brokerage firm, to get a variable annuity. Now, the variable annuity, the words matter. You think variable, what does that mean? That means that the money is invested and the value of your money is going to vary according to how the market does. Most variable annuities, the investments inside that annuity are tied to the market. It's not the insurance company guaranteeing your principal. Your money now is invested in the stock market. You can have stocks and bonds, other things within the investment categories available in the annuity. They look a lot like mutual funds. Technically, they're called sub-accounts. But the variable annuity, the thing that makes it different is that it's not guaranteed by the insurance company and your principal can go up and down. Now, I think back to the late 90s, early 2000, when we had that 3-year drop from 2000 to 2002. The stock market fell almost 50%. A lot of the people that got hurt during that period of time were people that had variable annuities and didn't realize fully that they had their money in the market. So a consideration with a variable annuity is that your money's in the market unless you choose a money market or fixed option, but most of the time people don't. And this is one of the places where people sometimes also get tripped up on fees. Variable annuities can, but not always. This is not an indictment on the product. I'm just going to tell you that sometimes I see people confused and very unaware of what the variable annuity costs. I've seen sometimes a variable annuity cost as much as 3, 4, or more % per year to hold it. So a variable annuity, now the advantage, it can grow in value. So it depends on why you're getting the annuity. Immediate annuity, fixed annuity, variable. The fourth type is what's called an index annuity. It's got a couple names. Index annuity, fixed index annuity, equity index annuity, that's all the same thing. It's a fixed annuity, which means your principal is guaranteed and to be honored by the insurance company. They're going to back up your principal and say, you put this money in, we're going to make sure that money's there for you. But the difference is that the interest is going to vary according to the market. Well, isn't that a variable annuity? No. It's an index annuity. It's a fixed index annuity. Your principal is secure. Your interest is what will vary according to the market. So the fixed interest annuity and fixed index annuity are both fixed annuities. So you see how just this quick overview, how this can be confusing. So you want to think about how this product or these products might fit for you, okay? There are going to be times when one particular product makes sense for one situation where another one fits in another situation. So the first question is going to be, how does this fit for me? And if you're working with an advisor, are all of them to be considered? Not all advisors work with all types of annuities. And not all advisors work with annuities, period. There are some financial advisors, and I'm using that term as a broad umbrella of financial people, many don't or won't or not allowed to or don't have the license to offer an annuity. So when you talk to anyone, an advisor, if you're going to ask somebody to guide you on selecting an annuity, or at least discussing whether it would be an appropriate fit as part of your overall financial plan, and I'm going to keep saying that, it's part of an overall financial plan, can they help you? Do they have the license? Are they allowed to do it? And if they are able to offer certain products, do they have enough choices? Is it one company that they can make available? Or are there many companies that can be considered? So when you think about these different products, they have to be weighed and evaluated, but you want to make sure that whoever's going to advise you can look at different choices for you. And again, some advisors won't talk about annuities because either their company doesn't allow them to do it or they don't have the license to do it. And you may have seen on television, there are some TV commercials that talk about, don't ever do an annuity. Do this instead. You know, that's all part of that financial services war that goes on every day of competing providers who want you to buy this, not that, invest this way, don't do that. And so there's always this constant tussle that goes on about what product you should be looking at. So if somebody is saying, never get an annuity and do this instead, well, probably they're not licensed to offer the annuity, and they have another thing they want you to get from them instead. Okay? We all recognize that when we go car shopping. You know, if you go to the dealer at whatever particular model or company is, they're not going to send you down the road to another dealer to buy another car that they think is right for you. They're going to try to sell what's on the lot, right? We all get that when we go car shopping. The same is true for working with financial professionals. You need to make sure that they can get you any car, or make sure there's enough choices that you're not getting the same thing. And I have seen and gone behind other financial advisors that everybody's getting the same thing. Now, is that because everybody's situation just happens to be exactly the same and everybody should get the same product? Come on. So you have to make sure you're in the right place to get the right product for your situation. And I want to also share one final thing about annuities, and that is that sometimes some of the features are overstated or oversold. There, I said it. Some of the features sometimes are oversold. Depending on what interest rates are at any given time, sometimes the rates can be very competitive with other products, sometimes not. But if you hear somebody say something that just seems not realistic or too good to be true about an annuity or any other financial product, stop, wait, pause, get it in writing, and also always ask about all fees in writing. So make sure you know what it's costing you, and ask the advisor how they are paid. Ask them to disclose that in writing. You just want to know that you're getting a fair shake and that you have clarity in how that annuity is being presented to you. They can make sense, don't get me wrong. I like annuities as part of an overall financial plan. But getting an annuity is not a financial plan, and you should not sacrifice your liquidity to get an annuity. And the features are attractive, but you need to maintain liquidity. So I like to see an emergency fund. I like to see monies that are liquid that maybe are invested in the stock market or in bonds or a mix of mutual funds, and maybe an annuity. But I don't want the annuity to dominate the financial plan because I just don't think it's flexible and liquid enough to help most people with their financial situation. All right, that's annuities. I hope that helps you, and I hope it helps you plan stronger. All right, time for viewer questions. Real quick before I do, though, I'm not negative on annuities. I just get a little frustrated when I see them not used correctly. So I think they make sense as part of an overall financial plan. You got that part. Okay. So viewer questions. And if you've got a question, remember, you can email me and I'll answer it on the program. And I'll change your name and information a little bit so that nobody will know it's you. Okay? So send them on in. All right. So today's questions actually come from the PlanStrongerTV production crew. So we've got two. I'll get to both. First one is, I've got 401ks and IRAs from previous employers, and they're just kind of out there drifting around and in a couple of places. What do? Do I leave them there, or do I try to do something with them? Great question, and the short answer is I like the idea of consolidating those orphan 401k or other types of retirement plans that you put money into through work. Because if you can consolidate them into one IRA, which is what you do, you bring them into one IRA. Once you have them in one IRA, obviously, one, it makes it easier for you to manage, but number two, the more money you have in an account can open up additional investment choices. Mutual funds, for example, will have a minimum investment amount. Now, it's kind of like the blackjack tables. This is the $5 table, this is the $10 table, that's the $100 table. So the more money you have, it opens up additional investment choices for you. I like that. And it just makes it easier to stay on top of it. So good idea to move it into an IRA. And if you have a year where maybe you don't make as much money, you might think about converting that IRA to a Roth IRA. Not a bad strategy. Question number two from the production team. If you're just starting out, you're not sure quite how to start to build this financial plan we talk about on the program. Step at a time. This doesn't have to be done overnight. And a lot of people I work with as an advisor have spent decades saving, accumulating, and building their financial future. And then they've come to me where maybe they have a 401k or they've got a retirement account or they've got cash in the bank. Everybody's on a journey. We're all going through life and trying to accumulate and prepare for the future. So what do? You save up some cash emergency money. Okay, you need to have cash on hand. Pay off any debt. Work through that debt. Make sure you've got your insurances in place. If you don't have health insurance, what's the point of having an investment account? Okay, so just take baby steps, step at a time. But as you build up, you'll see things start to quicken and move along, and you'll build up some momentum. If I look at where I am personally versus where I was 10 years ago or 20 years ago or 30 years ago, you know, it's been steps along the way. Doing this television program didn't happen overnight. It wasn't like all of a sudden one day I woke up and said, hey, I'm going to do a TV show today. It took a decade of thinking about and working on. I did radio for a while, okay? So all these things kind of work toward preparing us for where we are today. So don't be discouraged if it takes some time. Put your money away. Focus on saving for the future. And I've talked to many people that have made a lot of money. I've talked to many people that have saved a lot of money. And I've asked them, how did you get to this point? And you know what's interesting? It wasn't so much what they made as what they saved. In other words, you could make $1 million a year, but if you don't do anything about saving any of that and you spend every nickel, how much you'll have? The same as somebody who makes a lot less. In fact, some of the wealthiest people I've worked with over the years have been the people that not necessarily make the most, but they save the most. So if you do those things, you know what I'm going to say. If you plan for your future, if you build a plan and you plod along, you don't try to get crazy and swing for the fence. If you do those things and you're careful, you'll plan stronger and your financial future will be better.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.